If you've never heard of an IRA, or if you've heard that you need one but feel overwhelmed and don't know where to start, you've come to the right place. Today, we're diving into the world of individual retirement accounts, and I'll be explaining them in a way that's easy to understand and requires no prior knowledge about what they are or how they work. So let's jump right into it. So what exactly is an IRA? Well, it stands for Individual Retirement Account, which in the world of finance, where it can feel like things are purposely named confusingly just to gatekeep what they're for, I'm talking about 401ks, APYs, and W-2s, the Individual Retirement Account is surprisingly well named. Let's break it down. Individual, meaning the account can only be held by one person. Married couples, that means you each can open your own IRA, but you can't have a shared one. Then, retirement. This is an account specifically designed for retirement savings. It comes with a number of tax benefits, which I'll cover in a moment, but only if you use the money in the account for your retirement, which from the IRS's perspective is at age 59 and a half. And account. Now, it feels a bit silly for me to explain what an account is, but I've learned recently that a lot of people open up an IRA and put money into it only to not realize that you then need to invest the money that you put into it. The IRA doesn't auto-magically turn your money into more money. Like a bank account or a brokerage account, all an IRA does is hold your assets. So you need to invest your cash into something like the stock market to really see the balance grow. And don't worry, I've got some tips to help you figure out what to invest in as well. Now you may be asking, why do I need an IRA? Great question. An IRA lets you be in control of your retirement savings, but the real benefit of an IRA over some standard investment account is the tax benefits. Now, this is where I think most explanations about IRAs start to break down, because US taxes are ridiculously complicated and hard to simplify. But that's why I've come up with a one-of-a-kind, totally unique acronym to help you understand US investment taxes, and I call it FML, or First, Middle, Last. First, Middle, Last describes the three main points that you get taxed on an investment. First, you get taxed on the income you use to buy an investment. Let's say you want to invest in Apple stock using the money from your job. When you get your paycheck, you may notice that it's way less than what you were promised when you first got your job offer. And that's because for most people, taxes are already taken out of your pay and sent straight to the IRS as you earn it. This is the first point that you're taxed. Then, there's the middle point, which is when the thing you invested in generates income and you pay taxes again on that. Going back to our Apple stock, they have historically paid a dividend of around 0.5% a year, so for every $1,000 worth of Apple stock that you own, they will pay you roughly 0.5% or $5 a year on your investment. Unfortunately, that $5 also gets taxed even if the money never gets taken out of your account. Finally, there's the last point you get taxed, which is when you sell your investment. If the value of our Apple stock in this example went up from the time you bought it to the time you sold it, you get taxed once again on the amount that it went up in value. Talk about FML, right? And this is where the beauty of IRAs come in, as they essentially let you skip two of the three parts of FML depending on the type of IRA you have. There are two main types of IRAs, the Roth IRA and the Traditional IRA. Both of them offer tax advantages, but with some key differences in when you get those benefits. With a Roth IRA, you put money in that you already paid the first stage of taxes on, but you instead get to skip out on the middle and last stages, so you can take out your money in retirement tax-free. In other words, since you've already paid taxes on the money you contribute to a Roth IRA, you never have to worry about paying taxes on that investment ever again. With a Traditional IRA, you get a tax break up front, so you pay no taxes on the money you put in until you withdraw it during retirement. This basically means you're skipping the first and middle parts of FML and only paying taxes on the last stage. Also a quick note, since you likely already paid taxes on the money you are contributing to a Traditional IRA, the amount that you save in taxes will instead reduce what you owe when you file your taxes for the year, which may result in a bigger tax refund. So which is better between a Traditional and a Roth IRA? Well, with a Traditional IRA, you pay less taxes now when you contribute the money into the account, while with a Roth IRA, you pay less taxes in the future when you withdraw from the account. So the question of which is better is basically a question of whether you are in a higher tax rate now than you will be in retirement, and are therefore saving more by not paying taxes now, or if it's the other way around where you expect to be in a higher tax rate during retirement, so you would rather just pay the taxes now and get it over with. Now, this is unfortunately an impossible question for most people, since it's really difficult to know what your future tax rate will be. If you're thinking that, of course your tax rates will be lower in retirement because you won't be working, do keep in mind that there are a lot of sources of taxable income in retirement, such as Social Security, investment gains, and withdrawals from a 401k, just to name a few. Not only that, but the government can change tax rates at any time, and we currently face historically low tax rates, which one could reasonably expect to go back up in the future. All of this is to say, there's no easy answer, and to make things even more complicated, the traditional and Roth IRA both have their own eligibility requirements based on your taxable income for the year. If you have a workplace retirement plan like a 401k, your taxable income must be less than $73,000 in 2023 to get the full tax benefit from a traditional IRA. On the other hand, contributing the full amount to a Roth IRA requires your taxable income to be less than $138,000. I'll add more details about this in the description below to avoid making this video even more complicated, but if you're looking for a totally not financial advice recommendation, I personally think that the Roth IRA is better for most people, which is why my next video will explain that in greater detail, so make sure you're subscribed for that. The one thing that I can say with certainty is that it's better to open and start investing in your IRA early, rather than waiting around for years being unsure about whether you'll save a little bit more with the traditional or Roth IRA, or what financial institution you should open your IRA at. But how do you actually get started? First, you need to figure out where you will open the account. The big three brokerages in this space are Fidelity, Vanguard, and Charles Schwab, and they all pretty much offer the same services and experience, so just pick the one that looks the best to you, or roll a dice. It really doesn't matter which one you choose. Once you've decided, you can go through their website to sign up for an account and go through all the sign-up steps, such as providing your information and linking a bank account. With your account set up, you can finally contribute money into the account up to the yearly maximum. In 2023, the annual contribution limit is $6,500 or $7,500 if you're age 50 or older. Lastly, and most importantly, you want to invest the money in the account into something that can actually grow over time, instead of just leaving it in the default account, which is basically just cash and won't grow by any meaningful amount. It's up to you what you want to invest in, but for those of you that want a very hands-off experience, investing in a target date fund set to the date of your retirement is a great option, as they are a set it and forget it type of investment. Target date funds are basically just investments that hold a mix of both stock and bond index funds. So early on, they hold a lot of stocks, which are generally pretty volatile, but with a good expected return. And as you approach the date listed on your target date fund, the fund will automatically and gradually shift towards owning less and less stocks and more bonds, making your account safer the closer you are to your retirement date. You could literally go your entire life investing only in this fund. I hope this explanation has helped you understand what an IRA is and encourages you to get started investing in your future. My next video will be going a bit deeper into some of the advantages of the Roth IRA that I wasn't able to cover here, so make sure you check that out as well. And if you're new to this channel, subscribe for more 5-Minute Finance.